Now that the market's cooling off a bit after a tremendous run, what's the prognosis going forward? We're in a weird moment right now, as I said at the top. We're constantly trying to guess the Federal Reserve's next move, and that means focusing intensely on every single macroeconomic data point. Get a read on the market's next move. Even in the midst of an earnings season where we've gotten some stunningly positive quarters, some negative tonight, we can't stop playing the darn Fed speculation game. But this is an incredibly confusing moment. The Fed's taking short rates already from 0 to 4.5 in less than a year's time. That's incredible. If history's any guide, those aggressive rate hikes should have been enough to send the economy to a tailspin. Yet we somehow created 500,000 jobs last month. Remember we saw that last Friday? Bringing the unemployment rate to its lowest level since 1969, 3.4%. We've made progress fighting inflation, but it's really commodity inflation. It's hard to tell if we can maintain that progress given the lack of a major slowdown outside of Silicon Valley. Remember, we're worried about wage inflation now. In short, anyone telling you they fully understand the economy is blowing smoke. We're in an unprecedented moment where the future is hard to predict. Requires a lot of guesswork, a lot of subjective analysis. And that's why I sometimes like to just take a more quantitative approach to the stock market as represented by the emotionless technicals. That takes the emotion-driven analysis out of the equation. It can be very helpful at certain uncertain moments like now. So tonight we're going off the charts with the help of Carolyn Boroden, a brilliant technician. She's teaching at im.academy SFX. That's the Stocks and Futures Academy. You can also find her on Twitter at Queen of Fibs, one term, because she can give us an empirical read on the market. First, you need to understand where we're coming from here. I want you to take a look at this chart. This is a weekly chart of the S&P 500. Boroden thinks it's important to analyze the October lows. You see this? Remember, as I see it, October's when the bear market died and the bull market took over. After the super strong dollar and long-term interest rates peaked, it created a much more positive backdrop for the vast bulk of the market. Not the mega caps, not tech, but everything else. And at the time, Boroden says there were a bunch of signals that would have let you predict the bottom, or at least an important low. She likes to measure past swings in a stock or an index. Then she comes up with key levels by running them through the filter of Fibonacci ratios, which is kind of a mathematical constant that repeats itself over and over again in nature. Small shells, flower petals, pine cones. Somehow these Fibonacci ratios also show up at key moments on Wall Street. Hey, look, don't ask me why. I have no idea. I just know it happens with alarming regularity, and you can bank on it. Look at this. This did indeed call the bottom. That's that confluence of cycles. Let's go further. Boroden uses this method to spot potentially important prices or important dates where security is likely going to change its course, its direction. When you get a bunch of them clustered together, as we did October 7th, which was the bottom, it becomes more and more probable that something big might happen. So you can see the weekend October 7th, right around the bottom, we had a confluence of 5 Fibonacci time cycles, 5 key dates where the odds of a reversal were high. Boom. That was the bottom. Of course, it's more of an art than science. Boroden likes to look for reversal within a week of these dates, either of the week before or week after. Sure enough, the S&P made its actual low less than a week later. The actual intraday low came the day before. Why bring up all the stuff that happened in October? Because if you know how it worked in the past, you can use the same method to spot potential trend changes in the future. So now, let's check out this weekly chart of the S&P 500 that's more oriented to what's happening right now. Unfortunately, Boroden spotted quite a few Fibonacci time cycles coming due this month. We've got 6 of them this week alone, which makes her think the odds of a bearish reversal are higher than we would like. That's the confluence, okay? Then we have 3 more timing cycles coming due near the end of the month, in the week ending on the 24th. See I'm sorry, I'm going to get all of those, and then down here too. Remember, you have this confluence of this date. Boroden also says that when you look at the daily chart, you've got similar timing cycles that are forecasting the same thing, which is not a pullback, but a meaningful pullback. Of course, just because we've got all these timing cycles coming due, that doesn't guarantee we're going to get a reversal back down here. But Boroden's adamant that we need to prepare ourselves for the possibility that February will not be a good month for the market. She recommends watching for any sell signals so you can ring the register and protect your profits. Beyond the issue of timing, she also doesn't like what she's seeing on the price front. Remember, Boroden uses the same method to find key support or resistance levels. She measures past swings, runs them through the Fibonacci machine, and comes up with the most likely turning points. Right now, she says the S&P is running up against a firm ceiling of resistance. This is where we are, okay? Between 4192 and 4199. I'm sorry, I don't want to make it so you can't see it. Okay? Which, by the way, is where we topped out just last Thursday. S&P peaking at 4195 before closing lower. Then there is another ceiling, this time at 4253, with still one more ceiling in the 4300s. She thinks the S&P might struggle to jump through all, which is really, in other words, if you can't get through this, it's not going to be static. While Boroden's not telling you to throw in the towel, she's throwing up the yellow caution flag here, because as she sees, there's a good chance the rally could stall out in the near future. In her analysis, time and price are both against us. Now, I know you don't want to hear this, but she's actually debating whether she should be even more negative. So take a look at the S&P 500's daily chart. Boroden has a particular buy-or-sell trigger. She likes to look at the 5-day exponential moving average and the 13-day exponential moving average. The 5-day, remember, is going to be in blue, and the 13 days in red. When the shorter-term 5-day, again, the blue, exponential moving average goes below the slightly longer-term 13-day, that's your sell signal. When it flips in the other direction, like we saw at the beginning of January, see this? Boom, it flipped. That was the sign that you had to buy. If you bought in the month of January at the very beginning, you're in heaven right now. As you can see, this trigger's done a real good job of keeping you on the right side of the market. Right now, it's still in bull territory, which is really the saving grace, because you know where I feel about this market. I'm bullish. But if that blue line goes below the red line, Boroden says you need to get a lot more negative. So we'd have to see a reversal, and this cross through over that. Hasn't happened. Bottom line, the charts interpreted by Carolyn Boroden suggest the incredible rally in S&P 500 might be running out of steam. If not in the next couple of weeks, then by the end of the month. She's not saying necessarily that we're headed for a brutal near-term decline, but you might want to pull in your horns for the next few weeks. Maybe even trim some of the stocks. We did this for the investing club today. Trimmed a little. I think the current bull market's resilient, but even bull markets will take an occasional breather, and the one that I believe is happening right now could certainly be tested during the month of February. Why don't we take some phone calls? Maybe we get some on this particular topic. Let's go to Justina in Connecticut. Justina.
Hi, Jim. I want to ask.
Hi, Justina.
Hi. I want to ask if now is a good time to invest in Exxon stock based on the record high profit earnings amongst the oil industry.
Look, I am thrilled that you asked me about this. We had a challenging period this weekend when we were on. We did our fabulous teach-in, our investing club teaching down in Florida. That's where we did our monthly club meeting. And I was adamant that oil is to be bought, not sold, that oil's got a bit of a floor here, and the ones that are being thrown away should be bought. I am going to say absolutely yes to your Exxon call. Buy some, don't buy all. Jeff Marks and I were talking a lot about not buying all at once, but I like your call, Exxon. Now let's go to Wayne in California. Wayne.
Oh, Jim, oh my gosh, I love this call. Oh my gosh, Jim, I bought 16,000 shares of Uber. Am I in or no?
All right, well, it reports on Feb 8 this week. I personally feel that you've got, look, I'm a big believer that there's Uber and Lyft, and I think Lyft is not doing well. And I think Uber is doing well. It's just that it's just far out in advance that you'll really know it. I think that, therefore, you're fine, but don't get too aggressive. That's enough, because it's just a very complicated thing that's going to be much better for you in the out years, as they call it, than right now. All right, the chart is interpreted by Carolyn Boroden, suggests that the S&P rally might be running out of steam, and you should pull in your horns, especially if things go negative near the end of the month. All right, much more mad money ahead. I'm sitting down with the CEO of Corteva Ag after earnings to see how the planting season and the profits might be for 2023. Then balloons might be a big hit at parties, but let me tell you why the Chinese spy balloon leaves little to celebrate on Wall Street, and maybe not as much of a laughing matter as you think. And all your calls rapid fire tonight says the lightning round, so stay with Cramer.